GM, good morning. Welcome to the Milk Road Show, the daily crypto show that won't make you say, if I had just cashed out earlier. I'm your host, Kyle Reedhead, filling in for Jay while he sips pina coladas somewhere far from the mic. He's turning 40, so happy birthday to Jay. But today we are joined by Jeff Park, the head of Alpha Strategies at Bitwise. Probably the coolest title. I'll figure out what that is in just a second. But the coolest title in investing, I think. Today, we're going to discuss how the world's changing, what that means for your portfolio. And at the end, we'll dive into some discussion around crypto treasury companies and something that Jeff has called the radical portfolio. This one's going to be a banger. But first, a few notes the Milk Road team wants me to say. Macro is confusing, and we've fixed that. The Milk Road Macro newsletter is your shortcut to understanding how the big picture moves the markets. It's delivered straight to your inbox twice a week. Hit the link in the show notes below to subscribe. Today's episode is brought to you by Ledn. Get cash without selling your Bitcoin. And meanwhile, ditch dollars, insure in Bitcoin. All right, Jeff, welcome to the Milk Road Show. As I said, head of Alpha Strategies. What the heck is that? It's a sweet title. I just want to know, what does that actually mean? What do you do?
Yeah, let's get into it. First of all, Kyle, thanks for having me here. And I hope, Jay, you're having a wonderful 40th and that you're doing much more interesting things than that we can navigate otherwise through the crypto markets. Right. 40th is a big deal. I also just want to say I'm a huge fan of Milk Road, and the fact that you guys are launching a macro channel really feels personally the moment that I feel I've been waiting for in my own journey professionally, where crypto meets macro at a level that everyone wants to learn more and level up. So I feel especially privileged to be a part of this journey. So I just want to get that out there.
Thank you.
But no, importantly, the dying question, what does it mean to be head of Alpha Strategies at Bitwise? As you know, Bitwise is mostly known for all the amazing suite of products we have across the index funds, the spot ETFs, including the Bitcoin products, as well as a suite of other indexed strategies. I lead the investment leadership for all the suite of strategies that are more actively managed, alpha-driven strategies. So in practice, what that means is we have a multi-strat solutions that we offer. We also have volatility harvesting ETF strategies on crypto equities that investors have come to embrace and seize the opportunity on what volatility can be if you were to monetize. And then the third is we also work with a variety of Bitcoin whales on their desire to achieve a certain yield, and we help them navigate all the different three-pronged approaches to find yield that are Bitcoin denominated assets.
Interesting. Very cool. We also just launched a Milk Road Degen newsletter, and it feels like maybe that's a little bit more in your lane.
In the end, macro and Degen all intersect. That's actually a perpetual path to heaven. So
I love that. We're going to talk all about this. Look, I've been following you on Twitter for a long time, and you have some incredible takes. You've recently been on some pods as well, so I've got to learn a little bit about kind of how you think about the world. And I'd love to, before we get started in more of the details, I'd love to zoom out and get your sort of like high level view on what's going on in the world. You talk a lot about how the world's changing. The 60-40 portfolio is dead. Just zoom out with us and help the audience understand like how you think about the world. And you can take that from whatever level you want, and then we'll sort of dive in deeper and get into the details.
Absolutely. So 60-40 is definitely dying. And more people are becoming aware of this as a phenomenon, but what they don't quite understand is why. And the thing that we all have to study and appreciate is how did we get here? And so the reason 60-40 is challenged is because they're actually 100% of something. And what it is actually 100% of is the amazing abundance of liquidity that has come to financial markets. And part of that is fiat debasement, but the other part of it is, in general, it's been decades of low yield across different parts of the globe that has promoted a kind of financialization of assets that historically was not possible. So, for example, today, a lot of sovereign funds and treasuries across the world will own equities as part of its balance sheet in a way to participate in what I would imagine is a construction to hedge for inflation. And so Japan famously owns a lot of US assets. They own US property, they own US equities, and all of it is a bit of a flywheel and a circular flywheel, in fact, of how capital flow has now become full circle between a lot of different dynamics in this geopolitical way. And because of this abundance of liquidity, the thing that tends to drive price is not really driven by judgment of value anymore. It's actually more likely that it's technical in nature, where there's incredible cross-border flows by a sovereign actor or a big institution, or there's a liquidity gap that unfolds because of certain things that are happening in the financial services system, where equities and credit are in fact tied hip to hip in the surplus asset that they are to be an inflation hedge. And so 60/40 is essentially dead because it's 100 of the same thing, which I call being long the global carry trade. And why I think Bitcoin is so interesting, and many of us are focused on the desire to diversify away, is because there are assets that actually is not part of that compliance system of the global carry trade yet. And those things can actually be the diversifier that the original 60/40 portfolio meant to be. And so Bitcoin is, of course, one of them, but there's a slew of other assets that I imagine talking through where they can serve those kinds of roles that I think investors have gravitated towards. And that's essentially the start of what I think the Bitcoin journey ultimately is about.
So do you see that this long global carry trade is sort of like unwinding or it's ending? And if so, why is that? Like, help me understand what's changing for this to no longer be bullish for you or no longer be like where the trend is going. Like, help me kind of connect the dots here.
Yeah, absolutely. So the era that we have experienced generally as we've grown up is broadly known as global trade liberalization. It is when the WTO has entered and to create an environment for competition for the current capital markets that we have today, which is really in the idea of promoting trade to find comparative advantages across different nations where everybody can be better off.
Mm-hmm.
I think what people are now realizing is that the quote unquote everybody is actually not good enough to describe the average versus the dispersion of outcomes that is still possible within one's own local economy. And so the instinct that the populists have had, which is that what's good for China is good for the United States, tends to have an asterisk, which is what's really good for the US capitalists tends to be really good for the Chinese capitalists, but the population may not actually be a beneficiary, nor the US population. And so this idea of trade liberalization having generally been the thing to drive growth is the fundamental barrier that we are experiencing and the unwind potentially in a protectionist mode that the world is entering. And so what this ultimately means is the relationship of trade in itself being a relationship of finance is being challenged. The only way you can run a trade deficit is if you run a capital account surplus. And if you unwind the trade deficit, by definition, you have to unwind the capital account surplus, which the US gets to enjoy its exorbitant privilege for. And so when we talk about the interest rate going up and it's remaining high today, it's sticky around 5% for the 30-year, and people are like, oh my gosh, like when is rates going to come down? Like 5% is unaffordable. Well, it might actually be the normally correct rate for a world where there's more protectionism, right? And so there's this bias we have as to imagining what the past would be reflected in the present, but this only works over a long period of time where there isn't like an inflection point. And the unique opportunity geopolitically today is there's a lot of changes happening. One of the challenges that I think we're seeing is that this trade deficit can be a profitable and worthwhile endeavor, but it may be that you want to do it with someone who's not directly your geopolitical rival. So the United States is on a journey, obviously still wants to run a trade deficit at some format because the dollar hegemony wouldn't survive without it. But maybe you actually have to run that surplus with different countries, right? Countries you consider more to be your allies. Maybe it's more like Vietnam and Korea and others, and decouple away from the geopolitical construct here in which the Chinese can also control and exert a lot of might on the capital account side. And I think that's kind of the structural journey we are all on. And it's affecting all of us because we're used to having low rates for a long time. You would say Japan has had decades of very low rates, even negative rates for a long period of time. And for the first time ever, now they're having inflation. You can't imagine what that means if you're a Japanese person, right? Because if you're in Japan, the norm was like your salary went down every year. Like I'm not even joking. Like you would literally get pay cuts because like price is going down. It's like an upside down world, and you get used to that. And then for the first time, it's like, oh wait, price is going up, and then you got to like adjust for all these things. And then if you see Japan as kind of the source and the kind of the litmus test for where the temperature of the world is, it is extremely important to focus on the Japanese yield curve to see the direction of where we're going to land across the geopolitical dynamic.
Interesting. So do you see what Trump is doing right now, and Bess and the rest of the team with these trade deals? Is this sort of the end of the world trade order and moving into something new? And this is kind of one of those inflection points that you're talking about? Or like when you think about, or you've seen what Trump has done over the last few months, what's your take on that? And what's he really trying to do here, in your opinion?
Yeah, it's funny you say the question about tariffs in general in the context of Trump, but if you take a step back, actually, tariffs have actually been a bipartisan industrial policy tool. The average tariffs on Chinese goods actually went up post 2018, even under Biden's administration too, and it actually remains elevated now already uh, in that 20% range versus the single digits that it was. So it's actually not a Trump era anomaly. It's a bipartisan effort, and it's become almost like a structural feature and not like a temporary tool for negotiation, even though it is being leveraged as some, but it's been around with us for some time now. So what we're seeing is like the emergence of like a truly durable protectionist like regime as a mindset. So I think we have to get used to it, and there's of course like implications for that for the consumer. Generally, we'll have to tolerate higher prices, but the other context to this is, well, what was the benefit? The benefit is like we're going to reshore and nearshore for like a new industrial boom, right? So this whole manufacturing construction spending, it's gone up over like 100% since 2021. It's driven by the CHIPS Act. You may have followed kind of the Inflation Reduction Act with clean energy. And these things are now driving like a domestic CapEx super cycle too, right? In the semiconductors industry. And so the things that are happening is more structural than people think. And China actually no longer is the top US trade partner. Many people still think it is the case, but it's not. Mexico and Canada has overtaken it. And that decoupling is a de-risking that is likely to continue, especially if you want to go on this friend shoring, even amongst those Asian countries like Vietnam and Korea and Malaysia, as I mentioned.
So as you think about, I mean, one thing is when there's change, I think people have a lot of fear, which I think we saw over the last few months. Now markets have rallied, and we're back at all-time highs in a lot of assets like Bitcoin. So we've sort of gotten past that. But I'm curious on your sort of outlook of where we're at, right? There's a lot of change happening. Like you said, 60-40 is kind of dying. We're sort of changing how we think about trade and the relationships with countries around the world. So there's a lot going on. And I think there's a lot of confusion, right? Everyone's like, I don't know what the heck is going on anymore. And I mean, there is an obvious trade over here with Bitcoin. I think we both agree with that. But before we get into Bitcoin, I'm just curious, like when you think of macro and you think of markets that pertains to that, whether you think of, I don't know if you think of like the business cycle or how you sort of think about the market structure, where do you think we're at today and kind of where are we going, let's say, for the rest of the year and in, I don't know, whatever time frame you want to go with? Are we structurally remaining in a bull market in terms of risk assets and things look good from here? Is what Trump's doing and this new change going to be a bad thing? Like, how do you sort of gauge what's happening right now?
Yeah. It's a uniquely challenging time and it's highly volatile time, and there's a lot of uncertainty. And some of the challenges is uncertainty is bad for business overall, right? Like it's actually one thing to put tariffs on and say it's a permanent fixture, but it's very hard for businesses to invest and actually do things if you thought you were preparing for a moment and it's unwounded. And then actually the next administration can come over and put out different executive order. And so you don't know how to invest. And once you can't invest, you can no longer manipulate the yield curve in the construction of what capex is. And so that growth model is being challenged, and that is a real feature. I think that the idea of rates being higher for longer is something that is entering the public conscience more realistically. And the truth is, you can control the front end of the bond market easily because there's a short amount of duration, but the long end, it's actually very difficult to control by the Federal Reserve. It's controlled by the holders of it, and it's controlled by essentially our foreign capital account suppliers like China. And so you've already seen this tension where people want rates to go lower, but actually you can't demand that to happen like with a wand. And actually, if the US credit gets downgraded, well, that's the thing that people care about in the long-term durability of getting paid back 30 years later, so yields will remain elevated. So what you're starting to see is like a little bit of a loss of control in the ability to like shape the yield curve the way that you might want to exert pressure on. And the reality is like the bond market is always right. Like, the market is what it is because there are people who are making bets on both sides, and it's generally pretty efficient. And so you can't fight it. You can try, and many banks have, and they have succeeded in different measures and failed spectacularly in others. But generally, the bond market and the vigilantes are correct. So I think we have to accept that possibility. And what this really ultimately matters is also the role of the dollar. Because I think ultimately the problem that the United States has is that post Bretton Woods, this construct of the dollar being the world reserve currency that is backed by nothing but really its words is at the core the central tension that is unfolding in its creditworthiness. Because everybody really wants dollars because they perceive it as a store of value, but dollar strength is directly adversarial to the export economy of this country. So the Triffin dilemma highlights this very particular tension, which is that what's good for foreigners who are demanding dollars may not be good for domestic consumers and citizens that are also demanding dollar. And so the ability to have like a neutral interest rate policy is a false fiction. Actually, there is no neutral interest rate policy because one person's benefit is the other person's cost. And it's almost impossible to fulfill those dual mandates because they're at odds with each other. And that Triffin dilemma exists because the dollar as a store of value is contradictory to like the role it serves for the inside economy and the outside economy. And that's why I think everyone is revisiting the idea of like, hey, how do we imagine a more neutral asset? Right, where there's a real mechanism to value its richness and poor cheapness based on the trade deficit and surplus. And in the past, under the mechanism where you had gold repatriation, that was the entire point. Like gold acted in a way to be an exhaust relief valve to let the currencies behave the way it's meant to. And that function is gone. So the reason Bitcoin is really interesting is because Bitcoin is a lot like gold, and it's got better features than gold, many would argue. And so if you can imagine Bitcoin tying back into a new version of a monetary order where there's a certain amount of credibility to the value of the fiat that is not deterministic by central banks, you can imagine it's actually going to be a more free-floating and competitive environment for like that price discovery, even amongst the conflicts that can exist. And so that's why I think Bitcoin remains at the core of this conversation. And then stablecoins, of course, is a part of that conversation as well.
Selling your Bitcoin should be a last resort when you need cash. That's why there's Ledn, the trusted platform for Bitcoin-backed loans. You can unlock cash in as little as 18 hours with no monthly interest payments and no prepayment penalties. They've issued over $9 billion in loans and never lost a single Satoshi of client funds, even during the chaos of 2022. If you're a long-term hodler, this is the move. Get liquidity without selling at milkroad.com/Ledn, spelled Ledn. Meanwhile is the world's first licensed and regulated life insurance company built for the Bitcoin economy. They do everything in BTC. You pay in BTC, they pay claims to your family in BTC. You take out policy loans entirely in BTC when you need liquidity. Protect your family from life's uncertainty and a broken financial system. Build intergenerational Bitcoin wealth while the cost of living skyrockets in dollar terms. Plus, get all the tax and legal benefits of life insurance now in Bitcoin. Visit milkroad.com/meanwhile to join the waitlist and get early access to the world's first Bitcoin life insurance.
Just based off that, I'm curious, is your long-term vision, and I don't know how long that would be, maybe it's 10 years, 20 years, whatever, is your long-term vision that Bitcoin replaces the dollar as the global reserve currency, or do you think they remain kind of working in tandem as they do today, but obviously Bitcoin becomes probably a more important piece of the puzzle? Or like, how do you envision this working out?
I think that Bitcoin will change also in 10 years, that we don't quite know what the final form of Bitcoin in itself may be to be able to know so presciently. But in the current state of what Bitcoin is, a store of value, the thing that people want to have as collateral, that they consider it to be pristine, just in that context alone, right? And nothing beyond for payments, is, I think, a way to imagine like a multi-asset collateral pool. So back in the days, the IMF had the construct, and they still do, the SDRs, special drawing rights, where it's a combination of different world currencies to have one neutral, like trade-weighted reserve asset that everybody holds as a way to kind of balance each other out. And the dollar is, of course, the biggest component of it, but like there's other currencies in there too. You could imagine Bitcoin being a part of it, or other assets that are a little bit more censorship resistant towards central bank policies and domestic agendas, where it's more valuable as a result of being a part of that complex. And so the thing that's most interesting to me is that Bitcoin's never going to replace the dollar, because the dollar is the way in which the U.S. can still control its own economic productivity and its cycles.
Right.
But having Bitcoin as collateral to the trade dynamic across currencies to anchor valuation, I think could be a world that is more likely than not.
Interesting.
And you're already kind of seeing it where like different countries are emerging to basically reimagine avoiding the dollars to conduct trade, because essentially like what they're just looking for is trade. Like they just want to get goods shipped across, and dollars the settlement currency because everyone agrees on the value. But it doesn't have to be. Like it actually doesn't have to be if people found credibility in something else. And the petrodollars, it doesn't get enough attention, but the whole idea of like the petrodollars in itself was that entire point. And you can imagine a different currency being used for that in the future too.
I mean, it makes sense what you're explaining. Like, just for example, and this is obviously completely different than what you're saying, but when the whole tariff situation happened, just me as an investor was sitting there going, okay, where should I park my capital? Like, I don't know what's going on. You think about like most people have their money in stocks, in mainly US stocks, and you're like, okay, these businesses are getting completely disrupted with like 100% tariff or whatever. And you're kind of like, where is a safe spot? And the only answers during that moment was like, okay, gold or Bitcoin. And it was like, well, even gold there was a moment they were like, is that going to be tariffed? So like a bunch of people moved it in before the tariffs came because people were afraid that their gold was going to be tariffed, which is wild to think. And it was like, when you really think of it, Bitcoin was the one answer. Now that's me as an investor, but also I would imagine companies and countries, as you just said, like they're looking for an answer too, right? There's a lot of things that have happened over the last few years that are kind of making, I think, countries realize like, hey, maybe holding US dollars or treasuries or whatever isn't the smartest decision, like when they sanctioned Russia. And so I think as time goes on, we're finding more and more reasons why you might want to move out of the existing financial system and into something that, as you said, is kind of separate from that. So I definitely, I can completely understand that. What's interesting as I think about what you're saying is, I think a lot of people today think of Bitcoin as just like the crypto version of the NASDAQ or the S&P 500, just this risk asset that moves along with stocks. And in the world you're kind of envisioning or you're sharing, it would be very different. I think that would when that happens, or if that happens, that's a world where Bitcoin continues to go up and yet stocks maybe go down. We never really have that. Do you think that that's a world that's coming in the near future, or whenever that world you're talking about exists?
Yeah. So let me see if I can answer this question in piecemeal. One is there's a common belief that like Bitcoin is a risk asset, and therefore it's heavily correlated with equities. It goes down together, it goes up together, and it almost points the finger at like Bitcoin being a risk asset.
Mm-hmm.
But actually, I think what is happening more likely than not is equities is following Bitcoin's lead, which is equities is just as much an inflation hedge in this world of global abundant liquidity where people are chasing a way to store value. The reason this is now palpably knowable, in my opinion, is because when you look at the actual constituents of the companies that make up these indices in the way that we've experienced these new levels, the S&P and the NASDAQ, once you take out like the big like 10 companies, almost the rest of like the Russell index or whatever has not performed. Actually, it's actually pretty flat. And so what you're seeing is these tech companies are becoming dominant, yes, but it's also because people perceive these tech companies as a worthwhile store of value. These tech companies are inflation proof because they're so integrated in our way of life, where they actually have so much control over like their business principles to be the inflation hedge. And so in a normally healthy stock market, actually everything should rise a little bit more equally. And what we're now seeing is it's actually not a normally healthy stock market. So this points to me as the evidence that people are not buying FANG and Max 7s because they're like an utter belief of how much they're going to grow. It's like, actually, there's nothing else to buy. And so that is more than like Bitcoin. And so I used to say Bitcoin will go up in value because people are going to find demand for it. And the marginal buyer will move the price. And this is true. But the way I think I maybe had misunderstood that is now becoming more clear is Bitcoin doesn't have to do anything, actually. Fiat will debase by itself. And that alone will actually just accelerate Bitcoin's price from a relative perspective. And that's the piece I think people are now realizing. If there's such like deficit spending across the entire world and that debasement is unstoppable, then Bitcoin doesn't have to do anything. The fiats just have to keep going down.
And that's not going to stop. So that's for sure.
Yeah.
It's so it's very interesting. This is my first time hosting the Milk Road Macro podcast. I obviously listen when Jay's doing it. And for the listeners, this is supposed to be about macro, not about crypto. And yet every single macro podcast we have done so far, we always come back to Bitcoin, not because that's even like something we're trying to do, but we're bringing on the best macro guests you can find. Jordy Visser, Dan Tapio, Mark Yusko, Jeff Park. The list goes on. And every single one, we're like, let's talk macro. And it moves into Bitcoin, because what I'm realizing here, and what you actually just explained it in a really good way, is like Bitcoin literally is macro. Like when you think of the world and what's happening and the way it's all changing, the answer to it is Bitcoin. And so it's very difficult, in fact, impossible, I think, today to talk about macro without talking about Bitcoin, because it literally is like the greatest macro asset probably we've seen in history.
That's right. You know, maybe taking a step back, one way to reframe this conversation is revisiting the radical portfolio theory that I've been using, which is not so much about Bitcoin, but about the complex system of investing for your modern portfolio. The thing about like the 60-40 and the 100 of it being compliance assets, and therefore we need 40 of something else, comes down to this feature, which is scarcity. And so it doesn't have to be Bitcoin. There's a lot of things that generally tend to be scarce. And that's a very important feature to diversify your wealth from the things that are being manipulated otherwise by financialization. Because all of these compliance assets, stocks, equities, all these things, I call it basically based on three things. It's got a lot of leverage in the system, which is actually how you juice the returns of it being very low in yield. And that entire happening is by the manipulation of time. And then you have these scarce assets, which is exactly the opposite. These assets are, by definition, very volatile because they're generally not super liquid, Bitcoin being the exception. And then the second feature is because it's so volatile, you actually can't put that much leverage on it. So it's the opposite of the global carry. And the third feature of it is these assets come to be born not by the printing machine, by the manipulation of time, but actually by the manipulation of energy. So very scarce things require real energy to create. Bitcoin, again, not to come back to it, is ultimately a battery that exists because of the energy consumption and proof of work. But there's a lot of other things that I would say in the same way are good stores of value because it takes energy and it's very volatile in price. But actually,
what are some examples, by the way, that you're talking about outside of Bitcoin? Just want to know what you're referring to as you say.
Yeah. So one category that I think all ultra high net worth billionaires already know is timeless art, right? Culture IP, in other words. Cultural assets also by definition are very scarce. And they actually have a finite life, right? If you have a painting and it burns, it goes away, you'll never get it back. And eventually over time, all these paintings will probably deteriorate, making each one more scarcer by the grandmasters that exist. And that means this art is valuable and it's a culture asset. And the price is probably very volatile, right? So if you bought the Jeff Koons balloon dog puppy thing and it was 10 million when Stevie Cohen bought it, and then someone might buy it for 40 million later, the price is whatever the price is. But the point is there's a scarcity value to that culture asset where people will buy it if there's a demand for it. And that thing can exist in many form factors. Other things that I would allude to would be like, you know, the Birkin bag, right? Or expensive watches from Patek, like things that people crave, demand, they're scarce. It takes a lot of energy to make it. And it can't just be printed. It's not a poster. and those things retain value too. All of those things in many ways have actually outperformed the S&P 500 based on like a 20-year timeline too, which is really, really impressive. Now, you're not going to buy like a bunch of bags and put it in your vault, but you could imagine it could be a strategy for those who want to imagine what tokenization might look like in the future if we ushered in that era for those things becoming more liquid and tradable as an asset class. There's other things that like if you follow generally what billionaires do, they're buying those things. That's actually what you got to pay attention to. So when you buy like a sports team, for example, why are they buying sports team? Like people know sports teams are not like the easiest thing to invest in. Well, it's tax advantaged in many ways, which means you're outside of the compliance system. It also is scarce. There's not that many. And it's also culturally important. So those things retain value in different ways, right? If the stock market goes down, like, yeah, maybe like the whole growth indicator is suffering, but the sports team is the sports team is the sports team. It'll be around and people have a value for it. And that fandom is still worth something. And so it retains value in a different way. And so there's categories of these things. Like part of why people buy real estate is to store value too. And then more specifically, if you want to be super pure about it, you just go buy land. And that's why farmland also has been like one of the best performing asset class ever, because there's tons of it and it's productive and it just is indexed to its like scarcity and inflation hedge for what it represents. And so you see all the billionaires buying loads of like farmlands, like most famously Bill Gates having done a bunch. And so it's Bitcoin's one way to do it. It's the easiest and most accessible way for folks to do it. But the reality is billionaires have been doing this already for a long time. They are not buying the S&P 500 in their portfolio. I mean, they are, yes, but the thing they're diversifying are these things: farmland, sports teams, yachts. Yachts are super advantaged with tax credits. They're also like the perfect hedge because maritime law is different than any law that you can ever have on shore. And they provide different kinds of censorship resistance, which you can't if you buy things on shore. So that's why yachts are important. Folks like Peter Thiel buying land in New Zealand, it's all the same category of like censorship resistance assets that store value that's outside the system.
It's all the same trade. And what I think is a good thing for all the listeners is you don't need to have the amount of money you need to buy a yacht or this land if you want to buy Bitcoin. You can buy it in any amount, which is,
that's right,
I think, one of the best unlocks of Bitcoin and what makes it such an important asset, not just for billionaires, right? It's an important asset that makes sense for literally everyone in the world, which I think is what's so cool about it. I want to talk about, and this is part of your radical portfolio, which I think we didn't really fully get into it. So maybe you can explain a little bit further, but part of it is Bitcoin. I think part of it is also something to do with MicroStrategy. This is what I cut you off on now. I remember as you were kind of talking about this radical portfolio. Walk me through what that is, and then we'll get into MicroStrategy and all the copycats that are coming out and everything going on with the sort of the treasury asset companies.
Yeah, so radical portfolio theory, again, it's meant to imagine a new 60-40 away from fixed income and equities as the anchor. And it is a new perspective that is driven by the cultural moment to demanding what assets should be. And so 60% of it is the compliance assets, everything from public equity, public credit, private credit, everything even in the category of alts. I actually put it in compliance assets. And the 40% are the things that are not part of the financial system, and therefore they behave differently. The flows are just not related. And so the prices of like these assets we just described are not likely to be cross to the same flows of an unwind of a thing that is happening from the other side of the market. And so that's kind of how you really want to diversify a portfolio, right? You want things that are uncorrelated, that push out the efficient frontier. So I have shared, if you wanted to have like a very simple 2-security version of like a 60-40 portfolio, and you only just want to own 2 things in your life, what could that simple portfolio be? And the simple portfolio that I shared was you can own 60% of STRK, which is MicroStrategy's preferred equity that was the first to come online, and then 40% Bitcoin. And to me, that represents the ethos of what I'm trying to deliver. 40% Bitcoin, we talked about it. 60% of MicroStrategy preferred is because MicroStrategy is still a security, right? Preferred equity is still a construct that is within the confines of Wall Street's financialization, and it pays a yield. And so that is actually more like a compliance asset than Bitcoin, right? If the world blows up, you're probably not going to get your money back from STRK.
Right.
I mean, maybe you would, I don't know, but in a way of like what censorship resistance and, you know, self-custodial things mean, like it is part of a system that is Wall Street. And so STRK happens to pay a very nice dividend. And if you believe that MicroStrategy is valuable because Bitcoin's valuable, and therefore this is a permanently valuable capital balance sheet, then it will continue to pay its rich dividend, which at pricing was 10%. So the simulation that I ran was if you buy 60 of that and 40 of Bitcoin since the STRK product launched, I think through like June, the first week of June, I forget the exact date, that 60-40 portfolio was up over 20%.
Unreal.
And that's valuable, right? Because that actually has nothing to do with like the rest of what 60-40 assets could look like. And so, you know, I would never suggest people should just buy 2 things in their portfolio and go to sleep. That's not financial advice. But the ethos that I'm trying to push here is to think outside the box. Think outside of like, what would a traditional financial advisor tell you? And if you were to doubt that and go a different direction, what would that alternative look like? And it will be things like this that I don't think today, at least, any financial advisor would really recommend.
Jeff, I thought for a second there that we were going to need to get you on the Milk Road Degen channel because of that portfolio. I'm kidding, but I love it. Look, help the listeners. There's a lot of confusion around what MicroStrategy is doing, and now there's MetaPlanet, and there's like so many, and there's not even just Bitcoin ones now. There's these treasury companies coming for Ethereum and Solana, and let's just start on the Bitcoin side, but help the listeners just kind of understand is this a good thing overall? Like you're saying to put, I mean, 60%, you didn't actually say that, but it's part of your radical portfolio. Help them understand, is this a good thing for Bitcoin, a good thing for what, you know, we're trying to do here in the crypto world? And maybe try to understand the benefits and then maybe like the risks associated with it. Just want to understand how you sort of think about this asset in this trade.
Yeah, sure. So I think one caution that I have shared with our investors is that when you want to really diversify, the goal you're trying to achieve is that they have to behave differently over a long period of time. And the number one trend I've seen is a lot of folks buy Bitcoin and then Bitcoin like adjacent risk that is actually very correlated, and they think they're diversified, but they're really not. And so the one thing that I do challenge is if you buy MicroStrategy, the stock, and Bitcoin, like you're actually probably more correlated than you think.
Right.
And of course, there's different risks, but directionally it's the same thing. And so if you then go one step further and say, hey, I have a really diverse portfolio because I have 10 of these Bitcoin treasury stocks, you know, I have MetaPlanet and 21 Capital and whatever, and you think it's a diversified portfolio, you know, my advice is think again. Like it's actually not that many degrees of freedom from the risk vectors you want to protect from. So on one hand, I think that is a little bit of a disservice where the illusion of choice makes it feel like you have diversity. But on the other side, I'm a very big believer that Bitcoin treasury companies are going to stay and they're going to be meaningful contributors to the industry. Part of it is because it is absolutely a fact that operating companies can do things that you and I as humans cannot access, including financing at a different scale, at a different cost, at a level of different jurisdiction. And then they can do things on the asset side that actually could deliver value that many retail investors may not choose to or know how to navigate. So there is a final form factor in which a permanent capital vehicle that is holding Bitcoin and then delivering a value added service on top could actually be valuable or more valuable than Bitcoin itself. There's of course different risks, right? It's an operating company, so it's a corporate structure, not a you know ETF, RIC fund, but or a spot asset. But you can imagine there are trade-offs to be made where people still find that to be a useful thing. That's why I think the journey that we are on for the revelations of these different Bitcoin treasury companies coming online is super fascinating. Every I think foreign jurisdiction that has a robust capital markets will demand one because it's still not possible to acquire Bitcoin in certain countries where it is actually easy to acquire a company that owns Bitcoin. Right. Japan, for example, very easy to buy MetaPlanet, impossible to buy Bitcoin. And so you could imagine MetaPlanet is actually playing a little bit of a role as a substitute good that is worthwhile. And then you're going to see a lot of these endeavors happen across the world, but then they're also, I think, going to level up to do more things beyond hopefully just acquiring Bitcoin and putting it to some productive use.
What sort of productive use are you thinking about with Bitcoin? Like I know we have Sailor's sort of like yield, he says, but that's just the ability to buy more Bitcoin, right? And have more than you had per share than previously. I think what you're referring to is there's some starting to come out where they're actually trying to generate real yield, whether they're sort of lending it out or I'm not sure what else they're doing, but interested to hear your take on like what other things that these companies are doing or you think they're going to do.
Yeah. So if you believe Bitcoin is a financial asset and it's going to be financialized, there's going to be a credit market. And the
Right.
credit market is going to be fairly robust. And there is opportunity then to earn yield. If you believe Bitcoin is actually going to be a volatile asset forever, which I happen to think it will be, then there's an options market for which you can generate yield off of the derivatives that can be traded against those assets. And that's monetizing the velocity of its volatility in itself, which is actually the conversion of energy, in my opinion, back to something valuable beyond just time repression, to put it back to the radical portfolio context. And then if you believe there's actually on-chain opportunities to emerge out of Bitcoin, where you're starting to see inklings of people wanting to advance the dialogue to it being more useful than it currently exists today, then you will find Bitcoin to actually be a little bit more dynamic than I think it is. And all of these elements, you have to have an open mind to those being value adds. And the fixed income market in the end is extremely, extremely large. And there's a lot to be imagined how Bitcoin can bring value to those through different kinds of programs, whether it's in the insurance world or whether it's in the securitization world. There's components of financialization that can happen in an operating company that you couldn't really do it yourself.
Right. Interesting. So a lot of different things that you can do with Bitcoin, but I think the average person probably won't do, but instead you can get a company to do it for you. And of course there are risks that come with that. I know most of the industry is scarred from last cycle on lending out Bitcoin. But obviously we're getting better regulation. We're definitely going to get all these different financial instruments and services for Bitcoin in the future. We just need some bills in place. We need more rules, more structure on that. And then look, there's always gonna be risk, but I think the opportunities are endless for what they can do here. Question outside of Bitcoin. So we're starting to see that, the copycat, and this is happening now there's Sol strategies, there's SBET that just came out for ETH. I've been hearing rumors for a whole bunch of others on even smaller tokens, which maybe that's a good thing, maybe that's a bad thing. I have no idea. Curious your thoughts more specifically on ETH and maybe on Sol strategies as well. These are sort of like the two other major crypto assets, not macro assets like this whole show has been about. So they're very different, right? You have Bitcoin over here as a macro asset. Just because ETH and Sol are crypto does not mean they are also a macro asset like we just discussed in the show. So I want to be clear there. But they're obviously, ETH is sitting at, 350 billion. Solana's, whatever, close to 100 billion. So they are somewhat important assets in the crypto world. Curious on your thoughts around them becoming companies doing these sort of treasury buys with these assets, because interestingly with ETH and Sol, you can stake and generate sort of real yield within the ecosystem. There is DeFi that you can actually lend out that maybe has less, I would call it smart contract risk, than trying to move Bitcoin onto something like Ethereum to lend out on chain. Curious your thoughts on this whole idea, because I think it's going to be, whether good or bad, a thing that's really going to come into the crypto space over the next, let's say, 6 months or so.
I think that it is inevitable whether people have a view on it or not. And I try to be neutrally objective to the trend and not infuse my own feelings first and foremost. And when I see from an objective level, there's basically a tension and an opportunity. The tension is most of how Bitcoin became financialized happened because the macro community decided this is a good store of value, that it's actually pristine collateral, and that there's a bid for it at all kinds of prices, especially if there were drawdowns. And then that in fact, it's not a death spiral, that there's a permanent floor, a permanent bid. And so the credit risk of default is actually contained. The only way you could bring financialization in these structures is you do at first want to access cheap financing. And the only way creditors will lend against assets is they have to believe the asset is good. So Bitcoin's unique because I do believe it has crossed that river in the institutional memory and experience to serve that role. Ethereum and Solana, I think, are on the journey, but I'm not totally convinced yet that people think it is. But there's other things that is actually going in Ethereum and Solana's favor too, which is they're actually more volatile.
Right.
than Bitcoin. And volatility is equally important in these financialization structures because volatility is actually how you bring cheap financing to the convert market and other kinds of manipulation that is possible within the realms of finance. Volatility is a source of energy. So Ethereum and Solana actually have one leg up versus Bitcoin from that domain. The question is, as an underwriter, what do you value more? Do you value the volatility more and therefore it's good? Or do you value the pristine collateral LTV dynamic more? And so that therefore it's good. I think we're all going to find out. But the reality is it's a different trade, but they can both work for different reasons. And hopefully in a world where people think that Ethereum and Solana are actually valuable and pristine collateral, then you could imagine actually it's almost perfect built for proof of stake tokens where the yield that you and I just discussed that is not possible in Bitcoin yet is actually already very advanced with Ethereum and Solana, where there's actual yield that comes from the productivity of securing the underlying consensus mechanism.
Right. Very interesting. It's a good take. It's interesting when I look back when Saylor first bought Bitcoin, I think it was around a $300 billion market cap. So about the same as what ETH is today. And so I would argue probably in 2020, Bitcoin was not as you said, the chosen one yet. I don't think everyone was like, yeah, this thing's definitely a store of value. I think when he did it, everyone was like, what just happened? Right. It was a confusing time, an exciting time for those that held Bitcoin, obviously. But then, I think you said at the beginning of this, these treasury companies are going to become a very important part of the entire ecosystem. And I would argue like they already have been a massive one. Like think of what Saylor's done over the last 5 years and what MicroStrategy has done and the amount he has taught other companies in the TradFi space, et cetera. I think he's made a big impact. And so hopefully, we'll see similar outcomes with ETH and Sol. Obviously nothing's guaranteed. So who knows what's going to happen here, but it's just interesting. It's around kind of the same market cap when it happened with Bitcoin. So we'll see what happens. Look, we got to wrap up there. Before we do, where can people learn more from you? You got a ton of insight, and I love everything you're teaching. So where can the listeners find more and learn more about you?
Yeah, absolutely. I'm active on X. My handle is DGT10011. And if you go to my profile, you'll also see I have a Substack. Sometimes I'll post some more long form writing and amusing ponderings there. So that's also a channel for us to connect. But otherwise, I'm here near and far on Twitter. So give me a ping, and I generally will be able to respond unless I'm unable to for compliance reasons. So reach out when you can.
Awesome. Jeff, thanks so much for joining the Milk Road Show. We'll have to get you on again, maybe a little bit more frequently. We have the Bitwise boys, we call them, on quite a lot on the Milk Road Show. So maybe we'll get you on as a frequent guest for Milk Road Macro. I think that would be great. For the listeners, if you'd like what Jeff was talking about today, please let us know in the comments. That'd be super helpful for us. And go give him a follow, check out his Substack, all those things. Jeff, again, thanks so much for everything. This was great to have you on the show. Great to learn from you. Everyone else, have a wicked awesome day, and we'll see you in the next episode tomorrow.
Thanks again. Nice to see you, Kyle.
As always, if you liked today's episode, please hit subscribe and make sure you follow us so you don't miss out on the next one. There's also a link in the description to our free 5-minute daily newsletter where we simplify crypto for you while making you laugh. And if you're willing to step up your crypto investing game, we're going to also leave a link for Milk Road Pro. You get access to our portfolio where you can see exactly what we are buying. This is your #1 resource to help you invest successfully in crypto. One final note, this show is for educational purposes only, and nothing we say is financial advice. Investing in crypto or any asset is risky, and you should never invest more than you can afford to lose. Thanks so much for listening in, my friends. Have a wicked awesome day.